January 1, 2006. The Real Estate Capital Scoreboard. January 2006. Although short-term rates are climbing, permanent rates and spreads remain unchanged during the past 6 weeks. For instance, the typical permanent loan pricing range falls within 90 to 150 basis points over comparable term treasuries for fixed-rate debt. The yield curve is still inverted with short-term rates, LIBOR close rent higher than Treasury notes, not seen since 2001. Typically such an inversion signals the beginning of a recession. However, the economy remains healthy by all current indications.
February 1, 2006. The Real Estate Capital Scoreboard. February 2006. The 30-year Treasury bond returned to the market with a strong ovation, as investors snapped up this maturity. Additionally, construction spending rose nearly 9% as the real estate economy stays healthy, buoyed by low interest rates. For the first time in more than a half a year, mortgage spreads are beginning to rise as numerous CMBS deals flood the market. Spreads have increased by 5 to 10 basis points across the board.
March 1, 2006. The Real Estate Capital Scoreboard. March 2006. Forward delivery, fixed-rate mortgages are extremely favorably priced, reflecting a flat Treasury yield curve. 18 to 24-month commitments are priced as low as 25 points over the immediate funding rate. During the past month, the yield curve inversion continues to defy ordinary pricing. The 5-year Treasury jumped ahead of the 10-year note. The Fed's 11th consecutive quarter-point increase had a proportional impact on Treasuries and LIBOR. Most long Treasuries and LIBOR rates climbed about a quarter point as well. April 1, 2006. The Real Estate Capital Scoreboard. April 2006. Interest rates increased nearly a quarter point across the board throughout March. LIBOR, 5 and 10-year notes remained at about the same levels, contributing to a flat yield curve. Construction/permanent loan combinations offered by life companies are beating conventional bank fundings as 10-year note pricing is more competitively priced than LIBOR-priced debt. To remain competitive, lenders offer guaranteed availability of secondary financing at a future date as part of a higher leverage funding package. Terms and conditions vary widely for funding of additional proceeds. However, the discussion of future extra proceeds certainly generates more borrower interest.
May 1, 2006. The Real Estate Capital Scoreboard. May 2006. After staying flat for most of the quarter, mortgage spreads widened by at least 10 basis points. Lenders are starting to saturate the market with CMBS issuances. As a result, a rate differential of less than 15 basis points separates 5 and 10-year debt. Signs of slowing down market conditions lead to more conservative underwriting for new construction deals, particularly in the for-sale condo sector. Lenders require equity contributions of at least 20% and 50% plus presale levels. Permanent debt is viewed as a hedging strategy for protecting seller values. As rates keep rising, sellers maximize leverage and request assumable debt with liberal prepayment and assumption provisions for future buyer prospects.
June 1, 2006 The Real Estate Capital Scoreboard June 2006. With the exception of LIBOR, which climbed nearly 10 basis points, rates are nearly identical to last month. Throughout May, rates fluctuated by about 10 basis points. Although interest rates are rising, property capitalization rates are slow to follow. High-quality income properties are in short supply. Numerous buyers will purchase new construction, as property sales prices approach reproduction costs. Even with negative mortgage news about agency accounting issues and rising loan defaults, mortgage spreads still remain very attractive. Experts predict widening spreads as more such news filters into the realty capital markets.
July 1, 2006 The Real Estate Capital Scoreboard July 2006. The mortgage yield curve is nearly flat. Class A, B and C properties are tightly priced within about 15 basis points per category differential. Within property categories, for example, retail versus lodging, about the same relationship exists. While rates bounce within 0.25% throughout the month, overall spreads and treasuries are relatively similar within the past 3 months. Pressure remains on capitalization rates and spreads to widen, but the lack of product still restricts conditions to a seller's market. The Fed raised the interest rate rise 25 basis points, the 17th straight increase and the highest level since January 2001. With current spreads taken into account, rates are at about the levels of this April. However, short-term rates jumped about 0.5 point during this quarter. August 1, 2006 The Real Estate Capital Scoreboard August 2006. Chicago, Illinois, August 1, 2006. As the mid-year mark passed the commercial realty capital markets, the following key trends are observed. 1. The market closed the July with the benchmark 10-year Treasury at about the same levels as early June. However, rates gyrated throughout the month with a variation of about 20 basis points. As compared to a year ago, Treasuries are about 0.5 point higher. 2. Current rates are within the 6% to 6.625% range for 5-year and longer permanent mortgages. Such rates are based on pricing of 100 to 160 basis points over 10-year treasuries and reflect conventional properties with full leverage, for example 75 to 80% LTV. 3. Smaller loans of $5 million or less are priced within the 6.4% to 6.75% range as are long-term, self-amortizing loans of 15 years or more, non-credit tenants. 4. While interest rates continue rising, income property assets are maintaining strong values. In particular, office buildings and apartment properties are experiencing healthy recovery. Investors are banking on cash flow upside. 5. CMBS loan performance staying strong. Competition remains keen, particularly for lower leveraged, high-quality loans. Pricing on such debt translates to as low as 80 basis points over the comparable term treasuries, i.e., 5.80%.
September 1, 2006 The Real Estate Capital Scoreboard September 2006. Chicago, September 1, 2006. During the past month, steady rate declines helped borrowers take advantage of favorable rates. No monetary policy changes returned more confidence into the bond markets. The yield curve tightened as 5-year Treasury notes are nearly the same as compared to 10-year paper. While short-term rates, LIBOR, prime, dropped slightly, the most favorable yields remain on the long end of the curve. Realty capital markets remain extremely competitive. Overall debt spreads across all property types dropped by about 5 basis points. As for equity markets, if interest rates remain steady, office property capitalization rates, in particular, should prove stable over the next 12 months because of improving space market fundamentals, including rental growth, and persistent investor demand. Lenders continue seeking yields at all ends of the risk spectrum. Open-ended construction loans without pre-leasing are readily supplied. Construction loan recourse guarantees are frequently reduced to completion only. Higher yields are in the 250 bits per second or more range over LIBOR for such risk profiles. The Real Estate Capital Institute's research director, Nat Svislow, notes with so much competition among lenders, almost nothing is sacred from negotiations. Borrowers have the upper hand today. October 1, 2006 The Real Estate Capital Scoreboard October 2006. Chicago, Illinois, October 1, 2006. Mortgage markets are flushed with cash. Borrowers have the upper hand in crafting financing options across nearly all underwriting variables including pricing, term, leverage and documentation provisions. In fact, fine-tuned underwriting based on specific market support and intelligent underwriting often yields results of at least 0.1% or more in reduced rates, as well as increased leverage levels in excess of 75% of purchase price/value. More specifically, the following 3 underwriting tips lead to more favorable financings. 1. Vacancy, adjusting vacancy levels where appropriate, 5 to 7% is optimum. The standard for a particular market may be inaccurate if the property is located in a strong submarket. Use direct comparable properties along with third-party market reports. 2. Cash flow trending, interpolate improving monthly cash flow versus annual cash flow, particularly important for properties with frequent performance adjustments such as hospitality and multifamily assets. Less important if strong market fundamentals are occurring over a gradual timeline or with long-term leases featuring minimal rollover. 3. Audit, detailed review of income and expenses. Key variables include rents, management, utilities, supplies and various vendors. Best performed by a qualified third-party firm which is independent of sponsorship. Aggressive outsourcing often can help reduce costs, particularly for larger portfolios. A utility audit is also a more common format of expense monitoring. Capital budgets should be reviewed. Reserve requirements can account for as much as 10% of cash flow. By and large, most borrowers will maximize the above-mentioned variables. Borrowers that are not in the market frequently or lack the sophistication of large organizations should hire consultants including mortgage bankers and other service providers offering instant expertise, suggests Nat Svislow, Research Director for the Real Estate Capital Institute. Real Estate Capital Scoreboard November 2006 November 1, 2006. Chicago, Illinois, November 1, 2006. Borrowers and investors are still enjoying some of the best debt costs in recent years. As is the case all year long, income property underwriting standards, both debt and equity, are flirting within extremely aggressive boundaries. Nearly all classes of income properties benefit from favorable pricing. By historical standards, properties located in secondary markets are barely lower priced than major market assets. In tandem with a flat treasury yield curve, real estate capital markets are tightly priced, allowing minimal premiums for property/location dynamics. What are current issues are discussed today. 1. Interest rate jitters. 2. Narrow pricing differentials among various asset classes. 3. Purchasing of properties at, or above replacement costs. 4. Risk-adjusted pricing of credit tenants. 5. Future ripple effect of housing on income properties, particularly the retail sector. Observations. Nats Vaslow, Research Director of the Real Estate Capital Institute advises, despite premium prices accompanied by higher risks, real estate capital markets are still relatively attractive compared to overall stocks and bonds. December 1, 2006 The Real Estate Capital Scoreboard December 2006. Chicago, Illinois, December 1, 2006, benchmark treasuries, 5 and 10-year, increased by nearly 25 basis points during November, settling at about the same levels as a month ago. The 10-year treasury converged with the 5-year, the continuation of a flat yield curve. Prime remains unchanged since August, while LIBOR slightly increased by the end of the month. Crowded realty finance markets flush with cash as long-term rates continue dropping. Funding sources more creative and aggressive than any time this year. New construction opportunities still attractive as institutional quality properties are priced near replacement costs. Complicated entitlements and limited infill sites keep land costs at premiums. Industrial, apartment, healthcare and lodging properties offer the most development options. Retail development focused on lifestyle and niche projects. Hot topics for the month? 1. Concerns about slowing economy, perceived as mild. 2. Improving office market fundamentals and limited new supply coming online. 3. Return on cost in major markets pushing developers to secondary and tertiary properties and locations. 4. Construction costs more attractive as raw materials and labor availability approach more normal levels. Observations. The Real Estate Capital Institute's research director, Nats Vaslow notes, everyone is flush with cash. Conduits control market share. Banks provide aggressive construction proceeds. Life companies offer fixed-rate debt with balance sheet flexibility. Adding, borrowers are the winners in capital market battles.